From Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
Welcome to Money Sense. This is Adam Butler on behalf of the CFA Society Cayman Islands, sitting in for Simon and Emil and the rest of the Money Sense crew. Today I have my business partner, Michael Philbrick, who's the CEO of Resolve Asset Management Global, with me. I thought that we would spend some time today talking about all of the economic and market and investment style predictions that come out this time of year from the major investment banks and from major media outlets who are often interviewing economists and chief strategists, et cetera. Seems like everybody has a strong opinion this time of year about what investors should expect from the economy and from markets in the year ahead. And so, we used to write an article series which we called Predicting Markets or Marketing Predictions, that talked about how challenging it is to predict what's going to happen in the economy and in markets, and ways for investors to navigate what is ultimately a really uncertain world. And so I thought maybe we could introduce some themes along that line. The first thing we wanted to talk about maybe was our journey to get here, because we didn't always sort of acknowledge just how challenging it was to forecast and navigate markets in an active way. And so, 2008 was a bit of a wake-up call for us about how challenging it can be. You probably have some memories from that time.
Oh, of course. And I think we're, as you say, we're in the season of marketing of predictions, and there's going to be a tremendous amount of news flow with these large houses coming out with how they are going to predict the unfolding of the economy, of inflation, various companies and their earnings. And this is kind of a challenging issue for investors to try and parse what is information and what is noise. And, our journey came from conceptually, one of the key points was coming across Philip Tetlock's work, where Philip Tetlock had participated in a number of deep think tanks and, the largest brain trusts in the world, talking about a number of different areas of expertise. So it wasn't just financial markets, it was geopolitical situations, and he would be present in these meetings and would notice that these experts in certain fields would make predictions, and most of the time those predictions didn't come to fruition. And in the subsequent meetings, those professionals and experts would say, well, it didn't happen, but it didn't happen for this reason. They would have a revisionist history to sort of justify the opinion that they had and why it didn't work out. And most often it didn't work out. And this led Mr. Tetlock to wonder about the efficacy of these predictions from these experts who had deep knowledge in their field, who had access to the most in-depth knowledge appropriate to make a prediction in these various areas. And so when he became tenured, he thought, well, I'm going to test this in my tenureship. And he took 20 years, 284 experts across multiple domains. I believe the experts all had post-degrees up to, PhDs were
average master's degrees, right. Average 16 years experience.
Right.
Yeah.
And 284 experts across 20 years and 82,000 observations. And maybe what did he find? I'll throw it back to you, because
this was remarkable. It was a major wake-up call for us in terms of how we not just think about markets, but think about making decisions in a complex world, right? And so across the 284 experts, not one of them demonstrated an ability to make predictions in complex fields like economics, climate, weather, geopolitical, all these different domains. Not one of them demonstrated an ability to make forecasts better than random guesses. Those who were more likely to be featured in journals, newspapers, the media, tended to be less accurate but more confident than those who toiled in obscurity. Those who were making predictions in their own field tended to be more confident but less accurate than those who were making predictions outside of the field. And so, it was just a general condemnation of the entire forecast industry. And of course, Dr. Tetlock went on to publish another book. By the way, this whole study was published in a book called Expert Political Judgment, which we would highly recommend that people read. He's also been on many expert panels, delivered a lot of public presentations on the themes. Then he went on to publish a book called Super Forecasters, where he identified the qualities of experts who were more effective than most at making forecasts in complex fields. And there were some lessons to be learned from that. But one of the core lessons was that there were some very simple rules that they followed as well to sort of compare expert judgment with simple things like the current trend will continue, right? Or the short term. Or, the effect will revert to the long-term average. And what he discovered was that these simple rules, these trend will continue or things will revert to the long-term average, did have a capacity for making forecasts that were considerably better than any of the experts and were better than random guesses. And so this was an interesting takeaway for us as we thought about how people might want to think about approaching markets as well.
Yeah, and I think the other thing that was interesting was the calibration. If they were put in a probabilistic environment, nothing is certain. So what probability do you assign? And so if we look at a weatherman is actually very well calibrated. If a weatherman says there's a 10% or 15% chance of rain, it rains about 15 times in 100. In the case of the experts, they were not particularly well calibrated. And, the more sort of extreme the views were, the less accurate they would be, which sort of makes sense. You're predicting an extreme outcome. It's going to be an outlier in any probability distribution. So the more extreme the forecast is, it's less likely to occur just on sort of the base effect of that. This prompted us to think about trying to look at markets in the sense of, well, let's look at them probabilistically, and how do we, separate the information from the noise? And I think, the financial media does a great disservice to investors because they provide so much information, and most of it is not meaningful in giving you any kind of directional feel for what is actually going to happen. And so, I think in this discussion, I think it's more about trying to help investors and people who are making decisions in these complex fields to try and make better decisions, to think about thinking, rather than try and give a market prediction on a December morning radio show. Yeah,
absolutely. And it certainly prompted us to investigate what kind of forecasts are especially difficult to make in markets, right? You predict the economy, and you can make a reasonably accurate prediction about the range of economic growth in the coming quarter or the coming year. Turns out that that's actually harder than most people think. But even if you can make an economic forecast that's reasonably accurate, does that tell you much about how markets are going to react to it? Counterintuitively, one thing that many people find surprising is that if you were to look back over, say, any 30-year horizon, and you were to identify the economies that had the fastest GDP growth, for example, well, you'd think that would correlate with the strongest stock markets. And in reality, there's either no correlation or the correlation goes in the other direction. Economies with slow growth ended up historically having better than average stock market performance, right? So you can't necessarily, even if you can predict what's going to happen in the economy, you can't necessarily predict what's going to happen in markets, right? And this isn't just true for stock market earnings. It's not just true for stock market direction or returns. It's also even true for the policymakers that are responsible for setting things like short-term interest rates. There's a really interesting study done by a group who analyzed the forecasts of the economists at the U.S. Federal Reserve during the Greenspan era. And it's called History of the Forecasters, an assessment of the semi-annual U.S. Treasury bond yield forecast survey. And I don't know, do you want to go into that?
No, keep going.
Yeah, so they analyzed the forecasts so there's obviously a large body of economists that work at the U.S. Federal Reserve, and every 6 months they forecast what the short-term Treasury rate is going to be 6 months in the future. Now keep in mind, these economists are charged with consulting on and eventually deciding where interest rate policy is in the coming months. So you'd think that they would have a better grasp than most on where interest rates were going to be. And it turns out that there was either no correlation between the forecasts that these Federal Reserve economists made about where interest rates were going to be 6 months in the future, or the relationship was actually inverse. So when they said that interest rates were going to go up, on average they went down. When they said interest rates were going to go down, on average they went up. So even policymakers charged with making decisions and setting policy, even they can't forecast where the things that they're going to ultimately control are going to be 6 months hence.
Absolutely. And this, I think there's a couple of different ways to go. The infinite game, finite game, the complex problem versus the complicated problem. So when you're sitting there, as Greenspan was from 1982 to 2002, your flight dashboard has the most tuned equipment to the U.S. and global economies. You have all of the interest rate information, and you're charged to make these decisions or predict where you yourself might take interest rates over the next 6 months. And even with that best flight deck and all of that information, you don't know. And this is an interesting point because it separates complex problems from complicated problems. If I'm a pilot sitting in front of my dashboard of air flight instruments, I can look at those flight instruments and take off and through course correction along the way, navigate to a destination with a very, very high degree of certainty.
And your actions in the airplane are not changing the conditions around you that are then impacting your flight decisions, right?
Correct.
Yeah.
This is complicated versus complex. This is, largely full information versus not full information and decision making under uncertainty. So here we have this complex dynamic system that has feedback loops that you are interacting with the market. It feeds back upon yourself as a Fed participant, and even you can't make these predictions. And we're seeing this today. We're seeing this in the Central Bank of the United States, the Fed, talking about inflation being transitory. Not so much. The Canadian central bank said we're going to keep interest rates very low for a long time, and talking about the real estate market in the summer of 2021. Right? These are like
low interest rates as far as the eye can see.
As far as the eye can see.
Yeah.
And 6 months later, those interest rates are 4 times higher. Not 4% higher, 4x higher. So again, we're dealing in a complex field where there's feedback loops and imperfect information. And this is decision making under uncertainty. And so it's complex.
It is. It's hard. And, so this is sort of coming out of 2008, 2009 and beginning to understand this from a general standpoint through Tetlog's research, and then through a more specific perspective in examining the forecasting track record of financial experts. We began to question at a fundamental basis, how should you approach the investment problem given what we now understand to be such a high level of uncertainty? And are there fundamental effects that we can identify that drive the returns of markets that we can at least introduce some better diversification for, right? Because if you can't make accurate forecasts, at the very least, you can make some strong assumptions about the drivers and diversify across them, right?
There's structural relationships between certain asset classes and certain regimes.
And we're going to talk about that immediately after we come back after this commercial.
After more than 20 years, the Cayman Islands Air Show is back. It's all eyes to the sky on Saturday, December 3rd for a thrilling air show on 7 Mile Public Beach. Witness amazing aerobatic maneuvers as world-class pilots put on a stunning show. Then see the planes and meet the aviators at the Island Air Hangar. Parking permitted at designated sites with free shuttle buses to the events. For all the details and event lineup, visit CaymanAirshow.com. The Cayman Islands Air Show. returns Saturday, December 3rd, 10 a.m. at 7 Mile Public Beach and 3 p.m. at the Island Air Hangar.
All right, we're back, and today I've got Michael Philbrick, CEO of Resolve Asset Management Global, with me. This is Adam Butler for Money Sense, and we've been talking about how challenging it is to make forecasts in complex systems,
Right.
and especially markets. And we reviewed a lot of the literature and experiences in trying to make forecasts, especially in markets, and then in this segment, we really wanted to dig into how to approach the problem of investing, acknowledging how hard it is to forecast what's going to happen in the economy and markets. Right?
Yeah.
So
thinking about what drives structurally asset prices, there are the three main dynamics of growth, inflation, and liquidity. And growth is, just what you might suppose it to be, global growth. There's growth happening in the economy. And when growth occurs in the economy, there are certain asset classes that do well. If growth is accompanied by benign inflation that doesn't disrupt growth, then that's a certain set of asset classes. Those are, your developed markets, your developed market bonds. These do very well. A product of pre-2021, where, you combine stocks and bonds. Bonds act as a hedge to stocks, and you have this very robust, low-risk, high-return portfolio, a Sharpe of over 1.5%. Or 1.5, almost hedge-like in fashion. So in that regime, that occurs. Then you have other regimes, sort of global growth, but with inflation, but the inflation doesn't choke off the growth. There's enough from the perspective of initial conditions and enough supply in the commodities that run the economy that it continues on. In spite of the inflation, the growth occurs. So emerging markets do well. Canada, Australia, these sort of resource-based economies do particularly well. There's growth in those economies driven by their underlying sort of a commodity basis.
I think like 2002 through middle of 2008.
Right, where those areas of the world outperform the U.S. markets substantially. Okay, so these are these structural relationships. On the other side, we get into slowing growth with either inflation or disinflation, which is, a topic of today, where now we've got inflationary forces and growth has already started to deteriorate. And so these structural relationships, though, are somewhat reliable. And if we think about this problem through the lens of diversification, first idea is do no harm. So the growth and inflation dynamics set up four regimes. And if we situate ourselves to have exposure in asset classes in those four regimes and balance the exposure not by the cap weighting, i.e. 25% of dollars in each asset, but 25% of risk in each regime exposed to those assets and balanced for the volatility that they would contribute to the portfolio, we come up with something that's sort of called risk parity. And this portfolio wraps its arms around the entire world of asset classes. People are selling and buying on different days for different reasons. Somebody's got an inflation prediction, and so those people are selling certain assets. Somebody else has a different growth. So all this interaction is happening in the markets day to day, but you've wrapped your arms around it, balanced your exposures, and now you have what should be a very reliable a portfolio of risk exposures that offset one another. And so you've got your arms wrapped around the world. Everyone's fighting what they think is going to happen, but you've exposed yourselves in a diversified and balanced way to try and harvest all of those risk premia at the lowest possible risk.
Yeah, it's kind of like it's the portfolio that you want to adopt for the Hippocratic Oath. First, do no harm.
Correct.
Right? We acknowledge that it's really hard to make forecasts. So we know that growth changes in expectations about growth and inflation too. And I think that's important because, as we mentioned before, economies with the strongest GDP growth often are not the ones that have the strongest stock markets. The markets that have the strongest growth from a stock market standpoint tend to be those that exceed expectations by the most, right?
Yeah.
So investors had low expectations for growth, but growth came in slightly higher than they expected without creating a lot of excess inflation, right? So it's that It's growth and inflation relative to what the market is currently pricing or expecting that drives changes in asset prices. And so if we acknowledge that it's really hard to forecast whether growth is going to come in higher or lower than what the market is currently pricing, or inflation is going to come in higher or lower than what the market is currently pricing, then, and you also acknowledge that changes in asset prices are driven primarily by changes in growth and inflation expectations, then we have a framework to create diversification.
Right.
We have a group of assets that are likely to do well during high growth and low inflation, another group of assets that are likely to do well during high growth and high inflation, another group of assets that are likely to do well during low growth and low inflation, and another that's going to do well during low growth and high inflation, right? And one of the, just to unpack that last statement that Mike went, so the idea of diversity is owning all of these different types of assets that are designed to do well in different growth inflation regimes, like domestic and international equities, domestic and international bonds, along with commodities and some other type of sophisticated investments, inflation swaps, break-evens, that kind of stuff. Tips that are designed to do well as well in different regimes. But we all know that stocks, for example, and bonds have very different risk profiles, right? There's a reason why conservative investors are encouraged to have more bonds in the portfolio, and that's because they're perceived to be less risky. Their value doesn't fluctuate as much from day to day, week to week, and year to year as bonds do, right? So if you put 50% bonds in a portfolio, 50% stocks in a portfolio, and you observe the behavior of that portfolio month to month and quarter to quarter, most of the ups and downs are going to come from what happens to the stock side, because the bonds are not really moving very much, right? But what that also means is that the bonds aren't having very much of an influence on what happens in that portfolio. If you want the bonds, which do well during disinflationary lower growth regimes, to have the same impact as stocks so that the portfolio is nicely diversified, you've got to add more capital to bonds than you do to stocks, right? It's not enough to just have a diversity of assets in the portfolio. You also need to have those assets in balance. And when you've got both diversity and balance, now you've got diversification, and you've got the first do no harm portfolio that is resilient to all of the different growth and inflation surprises that might occur over time and that we've observed happen over the many decades in history.
And now this also sets the stage for thinking about how one might try to add some excess return, some alpha. Because now we've got a base portfolio that we can measure against, measure our tilts, if you will. So first is set up a portfolio that is robust, thoughtful. I think that this meets those qualifications, has access to all the various risk premia out there, and has balanced them in a way that is risk-centric, not capital-centric. So now we can look at that portfolio and say, well, where is the market under-anticipating or over-anticipating certain changes? And then you can tilt that portfolio. If you feel that it's going to be global growth, benign inflation, and abundant liquidity, you would overweight developed market stocks and developed market bonds. And in fact, pre-2021, for a decade, that was, a good thing to do. I don't know if people did it by happenstance or on purpose, but that was a tilt that paid more risk-adjusted returns.
At hindsight capital, every decade is a good decade.
Yeah, the crystal balls work. So again, but now you have something you can measure your interactions with the portfolio. So if you're going to stray from this fully diversified, well-balanced portfolio, how might you impart that extra knowledge or that tilt that you want to expose the portfolio to? Then you can see, well, did my tilts help or did they not help? And so these are the types of things that you can now look at. So should you add a factor like trend, for example? So going back to Tetlock, what worked? Trend will continue. Things are going to continue the way they are currently. And so that might be something that you impart to your portfolio. Say, well, and when assets are trending, I'll hold a little bit more of those assets. Or when they have good yield, carry. All things being equal, I'm being paid a higher yield on this group of assets. So I might want to emphasize those over those where I actually have to pay to own them. Something like an asset like gold, you have to pay to own that asset. That's got largely, most of the time, got a negative carry. And so its diversification aspect has to overcome that negative carry to be included in the portfolio. But if the carry's only slightly negative and it's very positively trending, that might be an asset that you would overemphasize in the portfolio. So these are the types of slants, tilts that you can make to your portfolio, but you've got a good base to start from.
That's right. And I think it's incredibly important to emphasize that it's a high bar in order to tilt away from that maximally diversified portfolio, because if you take these active bets, in other words, if you concentrate your portfolio in certain segments of the market, then you're giving up on that free lunch that you get from diversification, right? Diversification allows you to put all of these risky markets together, but because of the fact that some of them are zigging while others are zagging, they often offset one another's risks. And so you can hold all these risky markets in the portfolio, but the portfolio itself only has a fraction of the average risk that you would take if you were to invest exclusively in any of those markets, right? So if you're going to tilt away from that diversified portfolio, then you've got to have high confidence that those tilts are going to make sense, right?
Absolutely.
And so that means you've got to have good tools at your disposal to evaluate whether taking those types of active tilts, toward developed market equities, toward commodities, et cetera, whether the rationale that you're using to do that, the process that you are employing, has paid off over time, right? And so, that requires knowledge, expertise, et cetera, and an understanding of, in general, how investors in markets behave. Do they always behave rationally? And if not, how do they behave irrationally in a systematic way that we might be able to take advantage of?
I mean, it's the diversification, it's the rebalancing tailwind, it's the combination of all the betas. So you're saying, well, I'm going to take some of this combination of all these betas, well balanced, and I'm going to put that over here in some other exposure that's larger. Well, all of these things are trade-offs that you're making while you're making these decisions, and you want to see at the end of the day that those things are actually adding value, not taking away from the value of the portfolio, all the while trying to avoid the financial pornography that's thrown at you every day in all of the financial media, who are not trying to help you with your investment process. They're trying to sell you, whether it's a magazine, a TV, a radio.
Yeah, exactly. No, you're right. So hopefully we've communicated how difficult this investment process is, the value of diversification, how you might think about that. Thank you very much for joining us today on Money Sense, and we look forward to inviting you back next week.